In 1557, King Philip II of Spain made a decision that would echo through financial history. His empire stretched across continents, his treasury overflowed with New World silver, and his creditors, Italian and German bankers, believed their loans were the safest investment in Europe. Then Philip declared he couldn't pay. Not a complete default, but a suspension, a restructuring that forced creditors to accept new terms at lower interest rates and longer timelines. The most powerful monarch in Christendom, backed by unprecedented wealth, chose not to honor his debts as written. This wasn't villainy. It was a decision rooted in human patterns that repeat across centuries: optimism during borrowing, miscalculation about future capacity, and the discovery that obligations incurred easily become burdens that reshape everything. The common assumption treats debt as a simple mechanical cycle: borrowing money, repaying with interest, transaction complete. The historical reality reveals something more nuanced. Debt decisions mirror human tendencies: optimism about the future, difficulty assessing true capacity, preference for immediate benefit over deferred cost, and the recurring gap between intentions at borrowing and circumstances at repayment. Across cultures and eras, these patterns appear with striking consistency. The question becomes, what do centuries of debt relationships reveal about how humans make choices under uncertainty? To understand debt's historical role requires entering the worldview of societies where lending and borrowing were woven into the fabric of daily life, not viewed as financial pathology, but as practical necessity. Ancient credit systems emerged early in human civilization. Mesopotamian tablets from the 3rd millennium BC document loans of barley and silver, complete with interest rates and repayment terms. These weren't predatory arrangements imposed on the desperate. They were structured agreements between farmers needing seed grain before harvest and merchants or temples able to provide it. The system enabled agricultural production beyond what individual households could manage alone. The underlying attitude was pragmatic. Debt represented trust, the lender's confidence that the borrower would honor obligations, and the borrower's acceptance of accountability. Default was possible but socially costly, damaging reputation and future access to credit. The system functioned because most participants had repeated interactions, creating incentives for honoring commitments. In medieval Europe, lending took various forms. Jewish and Italian merchant families provided credit to nobility and merchants. Monasteries lent to local communities. Pawnbrokers served those with immediate needs and tangible collateral. The Catholic Church's prohibition on usury, charging interest, was circumvented through creative arrangements, partnerships where lenders shared profits, fines for late payment that mimicked interest, or simply operating in legal gray areas. Attitudes toward debt balanced moral concern with practical recognition. Religious texts warned against enslavement through debt, but they also acknowledged legitimate needs for credit. The question wasn't whether debt should exist, but under what terms and with what protections for borrowers. Borrowing felt reasonable for several reasons. First, it enabled growth. A merchant borrowing to purchase goods for resale could expand operations beyond personal capital. A craftsman borrowing to buy better tools could increase productivity. The debt was investment, and if successful, both borrower and lender benefited. Second, debt financed warfare, which dominated European politics for centuries. Kings borrowed to hire mercenaries, build fortifications, and maintain alliances. Victory could mean territorial gains and increased tax revenue, theoretically enabling repayment. Defeat meant default and creditor losses, but the calculus before conflict always favored optimism about outcomes. Third, debt smoothed consumption across uneven income. Farmers borrowed against future harvests. Nobles borrowed against expected rents. The timing mismatch between when resources were needed and when they would be available made credit valuable. This worldview, where debt was common, functional, and morally complex, set the stage for later developments. As financial systems became more sophisticated and scales increased, the underlying human tendencies remained consistent. Optimism about future capacity, difficulty restraining present spending, and recurring cycles of expansion and contraction shaped debt relationships across the centuries that followed. The evolution of debt as a systematic force in history is visible through the development of sovereign borrowing and bond markets, where human decision-making patterns played out at scale. Renaissance sovereign loans. The Renaissance saw the formalization of large-scale sovereign lending. Italian banking houses, particularly the Medici, Strozzi, and Fugger families, lent massive sums to European monarchs. These weren't simple loans. They were complex relationships where debt intertwined with trade privileges, mining rights, and political influence. The Fugger family of Augsburg exemplifies the pattern. They lent to the Habsburg dynasty, financing Charles V's election as Holy Roman Emperor in 1519, essentially buying the position through bribes to electors. In exchange, they received mining concessions in Spain and Central Europe, monopolies on certain trade goods, and repayment rights from tax revenues. The initial arrangement seemed rational. Charles controlled vast territories. Silver from the Americas was beginning to flow. Future capacity appeared enormous. Both borrower and lenders operated with genuine optimism. But the arithmetic proved challenging. Charles borrowed to fight wars across Europe, against France, against Ottoman expansion, against Protestant princes. Each conflict required more funds. The silver, though abundant, was already pledged to previous debts. New loans were needed to service old ones. When Philip II inherited this structure, he faced impossible obligations. His solution was the 1557 suspension, forcing creditors to convert short-term loans into long-term bonds, giros with lower interest. The Fuggers lost much of their capital. Other banking families withdrew from sovereign lending. The human decision here was revealing. Borrowers believed future revenues would exceed present needs, a miscalculation rooted in optimism about territorial control, resource availability, and military success. Lenders believed sovereign debtors were uniquely secure. After all, kings controlled taxation and couldn't flee jurisdiction. Both assumptions proved flawed. 19th-century bond markets. By the 1800s, sovereign debt had evolved into tradable bonds sold to dispersed investors rather than concentrated in a few banking families. This democratized lending, but amplified the same human patterns. Latin American nations, newly independent after Spanish colonial rule ended, entered international bond markets enthusiastically. They borrowed from British and European investors to build infrastructure, establish governments, and finance development. The appetite for these bonds was strong. Investors sought higher returns than domestic bonds offered, and the romance of new nations building futures appealed to optimism. The 1820s saw a lending boom. Almost every Latin American nation issued bonds in London. Investors subscribed eagerly. Governments spent freely. Then reality intruded. The project's finance didn't generate expected revenues quickly. Political instability disrupted tax collection. Commodity prices fell, reducing export income. By the 1830s, defaults were widespread. Mexico, Colombia, Chile, Peru, almost all suspended payments. British bondholders formed committees to negotiate, but recovery was slow and partial. The cycle repeated in later decades, periods of access to credit alternating with defaults and restructurings. The pattern visible here involves several human tendencies. Borrowers exhibited optimism about development timelines and revenue growth. They prioritized immediate spending on visible projects over building fiscal buffers. Lenders, after initial losses, eventually extended credit again as memory faded and new investment opportunities arose. European sovereign cycles. European nations followed similar patterns at larger scales. France's debt accumulated through centuries of warfare, reaching crisis in the 1780s and contributing to the revolution. The revolutionary government repudiated much debt, but Napoleon borrowed extensively for his campaigns. After his defeat, France restructured and gradually regained credit access. Spain defaulted repeatedly, 1557, 1575, 1596, 1607, 1627, 1647, and into the modern era. Each time restructuring occurred, partial repayment was arranged, and eventually new lending resumed. The persistence of this cycle demonstrates that both borrowers and lenders operated with short institutional memories. Britain stood as the exception, maintaining continuous debt service from the 1690s onward, building a reputation for reliability that reduced borrowing costs. But this required fiscal discipline that was politically difficult, involving higher taxation and careful budget management that other nations struggled to sustain. Human decisions and unintended consequences. The human choices embedded in these narratives follow recognizable patterns. At the point of borrowing, circumstances appear manageable. Future revenues seem adequate. The purposes, warfare, development, emergencies feel justified. Restraint appears timid or short-sighted, but the future rarely matches projections. Wars last longer and cost more than anticipated. Economic growth disappoints. Political stability proves fragile. The obligations that seemed reasonable become oppressive. The unintended consequence wasn't merely default. It was the broader effect on trust and capital flows. Each default or restructuring made future borrowing more expensive and difficult. It shifted wealth from creditors to debtors in ways that discouraged lending. It created legal and diplomatic complications that persisted for decades. Yet the cycle continued because both sides retained incentives to participate. Borrowers needed funds more immediately than they feared distant default. Lenders, diversified across many borrowers, could absorb individual defaults while profiting from the majority that paid. Neither side could fully internalize the systemic consequences of their individual choices. This dynamic, rational individual decisions producing collectively problematic outcomes recurs throughout debt history. It's visible in sovereign lending, but the same pattern appears in personal debt, corporate borrowing, and financial institution behavior. The specifics vary, but the underlying tension between immediate optimism and eventual accountability remains constant. Across these varied historical contexts, certain patterns recur that illuminate consistent aspects of human behavior around debt. Optimism during stability. The first pattern is the reliable emergence of optimism during periods of stability. When economies grow, when political conditions are calm, when recent memory holds no major crises, both borrowers and lenders become more confident. Borrowers assume future income will exceed present obligations. Lenders assume default risks are minimal. This isn't irrationality. During stable periods, these assumptions often prove correct. The error lies in believing stability is permanent. Each generation experiencing prolonged prosperity forgets that conditions change. Wars erupt. Harvests fail. Economic cycles turn. The stability that justified optimistic borrowing evaporates, leaving obligations intact. This pattern explains why debt crises cluster after long expansions. The expansion generates confidence. Confidence fuels borrowing. Borrowing reaches levels sustainable only if expansion continues. And when it doesn't, crises follow. Difficulty assessing future capacity. A second pattern involves the consistent difficulty humans face in accurately assessing future capacity. Borrowers at the moment of decision must project future income, future stability, and future costs. These projections are systematically optimistic. Psychological research confirms humans tend toward optimism bias, overestimating positive outcomes and underestimating obstacles. This tendency isn't confined to naive individuals. Sophisticated governments and experienced bankers exhibited the same pattern repeatedly throughout history. The Renaissance bankers lending to Charles V weren't foolish. They analyzed revenues, evaluated assets, and structured loans carefully. But they underestimated the compounding nature of warfare costs and the political constraints on taxation. Their projections, though analytical, were still too optimistic. Cycles of expansion and caution. A third pattern is the cyclical nature of credit conditions. Periods of aggressive lending are followed by pullbacks after crises, then gradual re-expansion as caution erodes. After the 1557 Spanish suspension, sovereign lending contracted. Bankers were wary. Interest rates rose to compensate for perceived risks. For decades, credit was scarce and expensive. But by the 1600s, lending resumed. New generations of bankers, less directly burned by previous losses, re-entered the market. New borrowers, sometimes the same sovereigns after partial reforms, gained access again. The cycle reset. This pattern suggests institutional memory is short. The lessons learned through painful experiences fade as personnel change and time passes. Each generation must relearn limits, often through similar crises. The role of collective action problems. A fourth pattern involves collective action problems. Individual lenders, competing with each other, face incentives to extend credit even when systemically risky. Refusing to lend means losing market share to competitors. Collectively, all lenders would benefit from restraint, but individually, restraint is costly. Similarly, individual borrowers face incentives to borrow even when collectively dangerous. A sovereign refusing to borrow, while rivals do cede military and economic advantage. A merchant foregoing credit while competitors expand loses market position. This dynamic makes debt cycles difficult to escape through individual virtue. The structure of incentives pushes toward overborrowing during good times, even when participants understand the abstract dangers. Restructuring as recurring resolution. A fifth pattern is the regularity of restructuring as the resolution to overborrowing. Across history, when debts became unpayable, the solution was rarely full repudiation or full payment. It was negotiated restructuring, extended timelines, reduced interest, partial forgiveness. This pattern reflects pragmatism. Lenders preferred partial recovery to nothing. Borrowers needed to maintain some access to future credit. Restructuring allowed both parties to move forward, even if neither got ideal outcomes. The implication is that debt relationships are stickier and more negotiable than legal formality suggests. The nominal terms matter less than the ongoing relationship and mutual need. The patterns visible in historical sovereign and commercial debt echo in later contexts, though the scale and instruments evolve. The 20th century saw repeated sovereign debt crises following the familiar pattern. Latin American defaults in the 1980s mirrored the 1820s crisis, enthusiastic lending during commodity booms, followed by price collapses and payment suspensions. The Asian financial crisis of 1997 reflected similar dynamics in different geography. European sovereign debt stress in the 2010s demonstrated that even advanced economies within monetary unions faced the age-old tension between borrowing capacity and repayment ability. Each episode prompted declarations that this time is different: new financial instruments, better oversight, improved institutions. Yet the outcomes remained recognizable. Optimism during stability, overextension during booms, crisis when conditions changed, restructuring as resolution. Corporate debt cycles showed parallel patterns. The leveraged buyout boom of the 1980s, the dot-com financing of the late 1990s, the private equity expansion of the 2000s, each involved periods where cheap credit fueled aggressive borrowing, followed by corrections when growth disappointed or conditions tightened. Consumer debt followed similar rhythms. Mortgage lending expanded during housing booms, contracted during busts. Credit card debt grew during economic expansions, defaulted during recessions. The scale and mechanisms differed from sovereign borrowing, but the underlying human patterns, optimism, miscalculation, eventual restructuring, remained constant. Financial innovation didn't eliminate these patterns, it sometimes amplified them. Securitization allowed debt to be packaged and sold, dispersing risk, but also obscuring it. Derivatives created leveraged positions that magnified both gains and losses. Each innovation was designed to manage risk, but each also created new pathways for the ancient pattern of overextension. The observation across these echoes isn't that debt is inherently problematic or that societies fail to learn. It's that the incentive structures and human psychological tendencies that produce debt cycles are persistent. They reassert themselves across different institutional contexts because they're rooted in aspects of human judgment that don't fundamentally change with technology or sophistication. Understanding this doesn't provide easy solutions, but it does suggest that the patterns aren't anomalies to be eliminated, but features of how humans interact with uncertainty and manage resources across time. The question posed at the beginning, what do centuries of debt relationships reveal about human choices under uncertainty, has an answer visible across the historical record. Debt relationships reveal humanity's persistent optimism about the future, the consistent difficulty in accurately assessing capacity, the cyclical nature of caution and confidence, and the gap between individual rationality and collective outcomes. These aren't modern problems. They're ancient patterns, documented in Mesopotamian tablets, Renaissance banking records, and every financial crisis since. What history shows isn't that people are foolish or that debt is inherently destructive. It's that certain human tendencies, optimism during stability, preference for present benefit over future cost, difficulty learning from others' mistakes, interact with debt structure to produce recurring cycles. These cycles aren't failures of imagination or intelligence. They're products of how humans perceive time, assess risk, and make decisions with incomplete information about uncertain futures. The patterns repeat not because each generation is ignorant, but because the underlying conditions, the incentives, the psychology, the uncertainty, remain fundamentally similar. History quietly shows how choices shape obligations, not through grand theory, but through the accumulated weight of countless individual decisions made in confidence and later navigated with difficulty. Understanding this doesn't offer prescriptions. but it provides perspective on why the patterns persist and what they reveal about the enduring aspects of human nature.